Welcome to this week's Investor Spotlight. This week we bury ourselves into what's driving consumption at the moment, reviewing what the major US retailers revealed during the US reporting period, and looking ahead to some key earnings from ASX-listed consumer stocks. The backbone of any developed economy is the consumer. In Australia, more than 50% of GDP comes from household spending, while in the US, it's roughly 70%. The global consumer is coming off a period of almost unprecedented strength. The actions of fiscal and monetary authorities in response to the onset of the pandemic saw interest rates cut effectively to 0%, while trillions of dollars of stimulus was handed directly to households. This drove a huge increase in incomes and also pushed joblessness towards multi-decade lows in many parts of the world. Saving rates also climbed markedly. In Australia, the household savings ratio surged to as much as 23.8%, which also bolstered consumption, with the domestic unemployment rate plunging to a 48-year low. Of course, this resulted in a skyrocketing of company profits. Of course, the boom in consumer spending is now facing a potential bust. As we discussed here last week, very strong consumer demand has exacerbated supply shocks to push inflation to 40-year highs in the United States and to 20-year highs here in Australia. That's pushed central banks to hike interest rates in a very aggressive fashion, with the federal funds rate rising to 2.5% and the RBA's cash rate rising to 1.85%. Fears are for now a major slowdown in consumption as policymakers look to cool economic activity. The bar was set low for US retailers going into second quarter results. According to data compiled by FactSet, analysts had forecast earnings growth of -9.4% and -2.5% for the consumer discretionary and consumer staple sectors respectively. The FactSet data suggests an underwhelming result for US retailers for this quarter as well. The numbers last updated on the 5th of August says that consumer discretionary stocks posted an earnings contraction of 18.2%, while the consumer staples sector exceeded estimates but still posted an earnings contraction of 0.9%. Of greatest concern might be the downgrades the sector delivered through the period. Estimates for Q3 earnings from consumer discretionary stocks dropped from 27.2% to 19.5%, while for the consumer staples sector, estimates for Q3 dropped from 1.5% to -3.2%. The dynamic led to a mixed set of numbers from Wall Street's retail heavyweights. The large cap retail firms beat estimates more often than not. However, in the case of giant Walmart, they came after two successive profit warnings in the lead up to their earnings report. A deluge of consumer companies will report full-year results this week in Australia, with the numbers expected to confirm weaker growth for the sector. Of most interest will be the guidance given by management, with investors concerned that the recent rate rises, cost of living pressures, and very pessimistic sentiment will see consumer spending and therefore corporate profit growth slow. Two of the most watched companies this week will be Wesfarmers and Woolworths. Wesfarmers will hand down its full-year earnings on Friday the 26th of August. According to data compiled by Reuters, the business is expected to report a more than 8% drop in profits for the year to $2.2 billion, in large part as rising costs eat into margins. Based on the same source, Wesfarmers is estimated to pay out a final dividend of 84 cents per share. The analyst community is mixed towards Wesfarmers stock at the moment. Of 15 brokers, the consensus rating is for a hold, but 5 have a buy, 4 have a hold, 4 have a sell, 1 has a strong sell, and 1 has a strong buy. The consensus price target is $48.16, marginally below where the stock closed trade on the 19th of August. The technicals show a primary downtrend for Wesfarmers shares. In the short term, the stock is counter-trending, with price pushing above the 20 and 50-week moving averages. Price is also trading within a trend channel, but is approaching its upper bound. Wesfarmers shares sit just below technical resistance around $49, which if broken may see buyers push the stock back towards $50. Woolworths reports its FY22 results on Thursday the 25th of August. Reuters data suggests the company ought to report full-year profits of $1.5 billion, which will be down more than 23% on the year prior due to both a drop in sales and a squeeze on profit margins. The company is tipped to pay a dividend of 49 cents per share. Broker analysts have a consensus buy rating on Woolworths, despite the $38.59 average price target being currently below the share price. Out of 15 analysts, 3 have a strong buy, 5 have a buy, and 5 have a hold, with 2 keeping a sell rating. The charts for Woolworths stock shows price approaching a key technical level of resistance at around $39.60 per share. Momentum has turned to the upside on the weeklies, however, with the RSI above 50 and price above all the major moving averages. The next major level of resistance is around $39.60 and around $41.60 per share, with major support around $38.10. Consumer stocks are entering a challenging environment as economic growth slows and cost of living pressures remain high. Profits are tipped to moderate in the quarters ahead, with the guidance provided by corporate management this reporting season being closely watched for how significant the slowdown could be.